Hello and welcome back to the Microlearning Institute. In this tutorial we look at IFRS 2 share-based payments, and we look at an example of how to account for a share-based payment which involves a grant with a performance condition in which the number of equity instruments varies. Again, you'll remember from previous studies that the equity recognized to the statement of financial position in relation to an equity settled share-based payment is calculated from the formula where we multiply the estimated number of employees who are going to be entitled to this equity settled share-based payment by the number of instruments that each employee will be entitled to, multiplied by the fair value of each instrument at the grant date, and we time apportion that equity over the vesting period that's anticipated, and we take a corresponding movement to the P&L as an expense. In this example, we're told that at the beginning of year 1, Entity A grants share options to each of its 100 employees who work in the sales department. The share options will vest at the end of year 3, provided that the employees remain in the entity's employ and provided that the volume of sales of a particular product increases by at least an average of 5% per year. If the volume of sales of the product increases by an average of between 5% and 10% per year, each employee will receive 100 share options. However, if the volume of sales increase by an average of between 10% and 15% per year, each employee in this case will receive 200 share options. And if the volume of sales increase by an average of 15% or more, each employee will receive 300 share options. So here we've tabulated the number of options that each employee will receive depending on the target performance improvement. We're also told that on grant date, Entity A estimates that the share options have a fair value of $20 per option. And Entity A also estimates that the volume of sales of the product will increase by an average of between 10% and 15%, and therefore expects that for each employee who remains in service until year 3, 200 share options will vest. The entity also estimates, on the basis of a weighted average probability, that 20% of employees will leave before the end of year 3. Now, we're told that by the end of year 1, 7 employees have left, and the entity still expects that a total of 20 employees will leave by the end of year 3. Hence, the entity expects that 80 employees will remain in service for the 3-year period. Product sales have increased by 12%, and the entity expects this rate of increase to continue over the next 2 years. So we can see that the 12% product sales increase is between the 10 and 15% threshold, so that would suggest that each employee will be entitled to 200 options. Now we look and we see how we account for the cumulative equity to the statement of financial position, and we see the 80 employees that we anticipate will benefit from these options, multiplied by the 200 instruments each that we now anticipate they're likely to get, multiplied by the $20, which again is the fair value at grant date, and it's now time apportioned over the expected vesting period of 3 years. So that gives us a statement of financial position equity of $106,667 and a corresponding expense to P&L. Next we look at year 2, when we're told that by the end of year 2, a further 5 employees have left, bringing the total to 12 to date. The entity now expects only 3 more employees will leave during year 3, and therefore expects a total of 15 employees will have left during the 3-year period, and hence 85 employees are expected to remain. Product sales have increased by 18%, resulting in an average of 15% over the 2 years to date. The entity now expects that sales will average 15% or more over the 3-year period, and hence now expects each sales employee to receive 300 share options at the end of year 3. So again we can see that because the target improvement has now exceeded 15% per annum, then each employee is now entitled to 300 options. Now let's see how we account for the cumulative equity at the end of year 2, and again we now revise our estimate of the number of employees who are going to be entitled to this to 85 employees. We now think they're going to be entitled to 300 share options per employee. Again, the fair value at grant date is $20, and we recognize it now over 2 years with respect to the 3-year vesting period. So the cumulative equity that we recognize to the statement of financial position is now $340,000, up from $106,667 at the end of the previous year. So consequently, we must recognize an expense to P&L for the difference, which is $233,333. We're now told that by the end of year 3, a further 2 employees have left. Hence, 14 employees have left during the 3-year period and 86 employees remain. The entity's sales have increased by an average of 16% over the 3 years, and therefore each of the 86 employees receive 300 share options. So now we can see that because our improvement has exceeded 15%, each employee is now entitled to 300 share options. Now we can calculate the cumulative equity to the statement of financial position coming from the 86 employees who are now entitled to vest these options by the 300 options that they're each entitled to because of the performance. We still measure these at the fair value at grant date, and now we cumulatively say this is the end of the vesting period, so we must recognize the cumulative equity in the period, and that equates to $516,000 of cumulative equity to the balance sheet, up from $340,000 the previous year, so we need to recognize a corresponding P&L expense of $176,000. Thank you very much for watching this short IFRS 2 tutorial from the Microlearning Institute.